And please do welcome Mr. Gary Smith to moderate the next session on Brexit.
Yes, thank you very much. If I can call my panelists up, I have Sven Berendt, who's Managing Director of Geoeconomica, a political risk research firm, Stefano Quadrio Curzio, who's Managing Partner at BC Partners, the private equity firm, James Burdett, who is a partner at Baker McKenzie, the international law firm, and Julia Prescott, who is the Chief Strategy Officer at Meridian Infrastructure. My name is Gary Smith. I'm Head of Sovereigns at the new Barings Asset Management. And if you're curious as to what that means, read about me and my panelists in more detail in your excellent book, which I would recommend, the information pack. The title of our session is Brexit, a one-off or a trigger for wider political and market volatility. I was extremely excited, and I would thank the organizers of the CrossAF event. Extremely excited to be invited to participate in this particular panel. At the time we started talking about it a couple of months ago, I thought Brexit was going to be probably the most important divorce-related event of the 21st century so far. Imagine my extreme disappointment to find out it wasn't the most important divorce event of this week after the news of Brad Pitt and Angelina Jolie's sad breakup. Which perhaps gives us a little bit of perspective. My job here today is to try and elicit an answer to those questions that we asked at the outset. To begin with, perhaps I can just set a little bit of background from a UK perspective. Here we're trying to get the angle on the politics and the investment possibilities, but just taking a snapshot of where we are today, from a UK perspective. I think the important point to make at the outset is that Brexit, the vote was not an event. It was a process, the beginning of a process that will continue for some time, at least 2 years and maybe 2 or 3 years. It's a process that will lead to the UK departing all EU institutions over time. Article 50, the infamous Article 50, will be triggered at some stage in 2017. There's some debate as to when that might be. There are good arguments for doing it soon. There are good arguments for delaying it. The international environment, and particularly the European political calendar, I think will play some role in that, but perhaps we can ask the panel to dig down a little bit deeper into that. There's going to be a lot of noise, both leading up to the invocation of Article 50 and during the process of renegotiation. What I can say from the UK perspective, and I believe, I voted to remain, and I was very disappointed with the outcome of the referendum. But what I can tell you is that there will have to be a trade-off between access to the single market and the point on free movement of labour. The UK politicians cannot have failed to read what was said by the voting population during the referendum campaign. Free movement of labour is a big issue for voters in the UK. Mr. Juncker has said we can't have access to the single market and give up on free movement of labour. Then this is, for me, the crucial sticking point. UK politicians, if they want to keep their jobs, cannot continue to embrace and accept free movement of labour. Somebody explained to me the point that the EU is a complex adaptive system, and I quite like this. I looked up the definition on Wikipedia this morning, and a complex adaptive system is described as a system that can change itself in response to changes in its environment in such a way that its performance improves. Now, is the EU really a complex adaptive system in terms of being true to that definition. What's clear is that it's not just the case that one country has gone and the other 27 carry on as they were before. The relationships between all 28 have changed, as we've seen from comments from Bratislava and particularly from the Visegrad Four. Everything has potentially changed. There are a whole series of domino effects perhaps taking place in Europe. And with that point, I'd like to turn to Sven and ask him to expand on what he thinks the Brexit vote and ensuing negotiations will mean for the rest of the EU. Sven.
Yeah, thank you. Taking up this point of complex adaptive systems. Yes, Europe is a complex adaptive system. It is a platform where nation states come together and try to figure out what is best for Europe and themselves, as 27. In that context, it needs to be explored to what degree the European Union itself is going to reform and where the UK fits into that puzzle. But what are some of the thoughts after the Brexit vote? What are some of the lessons that we have taken away after June 23? I think the first lesson to take away is the British love to take risks. This is what the Brexit vote really told us. They like to take risks and leave something behind that worked for the rest of Europe for the past, I would say, 60 years. Good luck with that. Second, for the time being, and that is perhaps a little bit of a counterpoint that you have taken when it comes to the domino effect. I don't see a domino effect in the rest of Europe. I see concerns, I see risks, and I see, of course, like everybody else, the rise of right-wing populism. But I don't see currently a majority of Europeans wanting to close down the European Union. I don't see it in Germany, despite the rise of the AfD. I don't see it in France, despite the popularity of Marine Le Pen. And I don't see it in the Netherlands eventually, where the party of de Wilders is struggling to gain further support. So there is no immediate domino effect in Europe triggered by the Brexit vote, but the risks to Europe have certainly increased. Taking a wider perspective, no global economic power is happy about the Brexit vote. Certainly not the United States, certainly not Japan, and certainly not China. We're discussing the One Belt, One Road project later today. China has a keen interest that the western part of that road is not ending in the middle of nowhere. So for that reason, it has an interest in an economically vibrant and united Europe. And Brexit puts that as a risk.
Thank you, Sven. I'd like to switch to the second part of our question, as set in the title for the agenda. Stefano, since June 23rd, if you can talk a little bit about the private equity flows, what's happened in terms of valuations, what's happened in terms of the availability of debt and equity, the number of opportunities, and the general sentiment in terms of flows in your market.
Yes, of course, with pleasure, because on the broader political topic, I have no insights at all to offer, so that's just as well. I think it's a long road ahead, and I don't know which way it's going to go. But I take the perspective of an investor, because that's my day job, and a lot of you guys are also ultimately here to invest capital for the long term. And in that regard, it has been a very strange period, because after an initial wobble, by and large, business has returned back to normal with a great degree of, I would argue, complacency, but others may argue a great degree of realism or even optimism. A few sectors valuations here and there, a little bit in the real estate space, which many of you maybe are exposed to, are down. But deal flow in the past couple of months and currently is extremely strong. Availability of debt finance, it's stronger than it was before the referendum. And pricing and valuations in the private markets are, I would argue, higher now than they were before June 23rd. As I say, one or two pockets of weakness, commercial real estate and low-cost airlines. Personally, as a long-term investor, although not as long-term as you guys are, I don't think that's a particularly attractive environment. So my perspective on the UK is don't touch it for the time being. You have deep pockets and long time frames, and the risk-adjusted returns today are not good. The whole thing might pan out fantastically successfully. It may not. Nobody knows. What is clear is that the market at the moment, certainly on the private side, is not priced for the potential risk. It is priced for perfection, and in that regard, I would not particularly be interested. The only one asset class that has, if you like, adjusted has been the currency, which has adjusted somewhat, but perhaps it'll adjust even more. And I think the UK has benefited massively over the past few years of political uncertainty elsewhere and has become a magnet for foreign investments. I'm sure many of you in the room have ended up investing large amounts of your capital in the UK. And the natural tendency to sort of wonderful haven of peace and stability takes some time to work off the system. But I don't think it is as good as people portray it. I think the currency still has plenty of downside. There is a central bank which is explicitly determined to devalue it further and to create inflation. And I think it is one of the few central banks that can do so, unlike elsewhere. So you're going to have a lower currency, higher inflation, a political class that is entirely untested. Everybody has changed. And so I don't think you can hang on to anything in particular. And assets that have not corrected. So as far as I'm concerned, sit on your money. Don't worry about the fees, because it's better to pay a bit of a fraction of a fee once in a while than, actually lose money. And I have no doubt that over the course of the next 3 or 4 years, you're going to pick up assets at far lower prices, because unlike Germany or unlike other European countries, China, etc., the UK actually needs foreign capital. It has the largest trade deficit of, I think, any country bar Albania, and therefore, ultimately, the capital needs to come in, to pay for that. And I think that opportunity will be created in the next 2 or 3 years, when perhaps the tide of optimism moves temporarily, to the other side.
Stefano, very interesting comments, and maybe I can break with tradition by immediately asking you a follow-up question. Your point on sterling is very well made. We've had the adjustment, and dip buyers may well have been attracted by that. Your point on your prospect for future weakness of sterling is noted. However, I need to come back to you on the point of, the UK has benefited by being a relatively tranquil place to invest in the past. And the key there is relative. I mean, if the UK is a little less attractive now for the reasons that you've outlined, it does really require somewhere else to be relatively more attractive. Where are those places?
I mean, our remit is Europe and North America. And ultimately, I'm looking for, again, where the expectation versus reality, if you like, is out of sync. I'm not saying that the UK is unstable. It's simply that it enjoys a reputation, which I think today punches higher than its weight. By contrast, Europe is obviously not perfect, but I don't think that anybody's touching it with a barge pole. It's not quite Russia, where my friend Konstantin has equal challenges, I'm sure, in getting investors interested in. But everything is a disaster. And I don't think it is. German business, fiscal position, external position is healthy. Italy is nowhere near leaving the euro, mostly because you can't actually leave the euro without leaving the EU. It's actually not allowed, so it's not going to happen without a massive breakup. And businesses are just still carrying on and doing their job and selling and exporting and not that bad. So you have economies, if you like, that have political challenges, but where we see opportunities that are underpriced, if you like, relative to others which are overpriced relative to their expectation, if you like. Is the mismatch between, if you like, a reputation and reality. Maurizio Tamagnini here, representing Italy, knows a lot more than I do on the country, which I know very little. But I still see that, in continental Europe, we're finding many things which are better priced for the risk embedded in it.
Thank you, Stefano. Switching to James and continuing the theme on the effect on private equity market. Can you elaborate, please, James, on that point, and particularly insofar as it relates to the co-investment model?
Yeah, certainly. Well, many people I've spoken to post the Brexit vote assume that the lawyers are going to do the best out of the mess that we find ourselves in. I'm not sure about that, to be honest, because I think our clients are far more likely to part with their money if they're doing deals that they feel are productive, rather than having to procure advice on the knotty issues that Brexit has thrown up. But I think, there are a myriad of legal issues thrown up by Brexit. Virtually every aspect of commercial and sort of social life in the UK is governed in one way or another by EU law, and private equity is no exception, as we all know. I think of the various different financial sectors and asset classes, I think private equity should have a relatively easy time from a regulatory perspective, leaving aside the observations on whether it's a sensible time to be putting money into the UK. But I think the private equity managers I've spoken to and the commentary I've read in the market is generally the sentiment is that it should be business as usual. And I think that's probably a fair assessment, because essentially private equity managers who are located in the UK, they need access to Europe both in terms of investors and also in terms of target investments. On the latter, there should be no problem. I mean, it's as easy as for a UK-based manager to invest in a European asset as it is a US-based manager. That shouldn't change as a result of our exit. On the fundraising side, I think it's potentially a bit more challenging, but the current regime under AIFMD, as some of you may know, explicitly caters for third country managers to offer funds into Europe, currently under what's known as the private placement regime, hopefully under a passporting regime in the next couple of years. So in terms of the legal framework, I think it's manageable. In terms of co-investments, I think by the same token, it should be manageable. I mean, many co-investment structures are effectively funds in their own right for regulatory purposes. So it's, the managers will need to make sure that they're structuring and indeed attracting their LPs into those co-investment structures in a way that's compliant. But I would say it's more around the lawyers needing just to tweak the dials a little bit rather than a fundamental shift from the legal perspective. Just, I can't help but comment on Stefano's observations on the if you like, the supposition that we may be over-optimistic or just pragmatic or just plain stupid when it comes to our view of the prospects for the UK in a world without the EU. I think what I would say is that again, from a legal perspective, the UK regulatory systems have, for a very long time, been very pragmatic in their outlook. And I think they have had a calming influence on their European neighbours. I will be very interested to see that when that influence is withdrawn, whether Europe swings towards a less business-friendly outlook. And I think that is a real danger for Europe. And it would be very disappointing were that the outcome. But if you look at the sector I'm most focused on, private equity, the regulatory regime that we now find ourselves in is workable in large part due to the Herculean efforts of the City of London and the Financial Services Authority to try and temper some of the more outlandish ambitions of our European neighbours. So, watch this space.
James, thank you. I do have a question, but we'll come back to that after Julia. Julia, you work for Meridian Infrastructure. Can you talk a little bit about the pipeline in infrastructure space, and particularly how opportunities may have changed since the June 23rd vote?
Yes, and thank you very much. I think what the first thing I'll talk about is a little bit about what the opportunity is now in infrastructure in the UK. I can't help but comment on Stefano's comments as well in terms of the relative lack of attraction of the UK. And I do this from a perspective of being a long-term 25-year greenfield infrastructure investor. It seems to me that one of the reasons why the UK is likely to remain relatively attractive as opposed to relatively unattractive is that there will continue to be a pipeline of well-structured, well-put-together projects certainly in the greenfield space for some time to come. And to be honest, we don't see that depth of pipeline of well-organized, well-structured projects in a number of other countries. And for that reason alone, I think that when we have the levels of liquidity that we currently see in the infrastructure investment market, that the UK, for all the potential uncertainties, is likely to continue to be a draw. And even since June the 23rd, there have been projects being closed, funds being raised. Terms and conditions haven't altered markedly. We've seen new offshore transmission lines being closed. We've seen a lot of bids coming in for the purchase of the M6 toll road. We've seen a whole series of new offshore transmission, new potential offshore wind projects. So I'm not as concerned perhaps as Stefano's opportunity. Uncertainty is still going to reign. But the UK has very significant infrastructure needs, as already mentioned, a well-structured regulatory system, and retains its attractions in terms of also being able to bring into the UK a very wide global variety of global investors. So I'm not so worried perhaps about the pipeline. But one of the things that I do want to reflect a little bit on about where infrastructure is going over and above the actual delivered and suggested pipeline. I mean, I think if you reflect on the Brexit vote, it was much more of a cry of anguish from the British people rather than considered deliberation of the facts. There was a statement of, don't listen to the experts from the Leave campaign. And the people who voted to leave were a curiously unlikely alliance of the non-urban, both a prosperous non-urban in the south and the poor end of the spectrum, the non-urban in the north. And there was a feeling of being adrift from the main city, from London as a decision maker. And again, if you think about it, this was also reflected in the state of UK infrastructure. We were hearing constantly about what's been called recently the 3 H's, the Hinckleys, the Heathrows, and the HS2s. But local concern was about the effects of immigration on local potholes, local housing, local schools, and local health. And it seemed to be, in the British way, people would normally grumble about this, but they were given the opportunity for a vote. And boy, they took it in terms of the leaving, the approach towards leaving. And this dissatisfaction, it's a dissatisfaction that we see not only in the UK, but a number of countries about the issues of globalization, about fractionalization. And unless people feel across the whole country that they have engagement in the future, you can see potential further fractionalization. And this was reflected in infrastructure development. Since 2010, and the advent of the coalition, subsequently the Conservatives, the focus is on economic infrastructure. Social infrastructure was the nice to have. PPPs actually gained a huge ideological stigma from the Conservatives. And it seems to me that to fulfill the country's needs, there needs to be more of a focus both on social, on community-based infrastructure. And I think I can see some strands of this happening, some likely statements in the autumn statement coming through later on this year in the UK. There are going to be smaller projects, more community-based projects. And in fact, some of the issues that we've seen on the larger projects, the Heathrow, there's some suggestion that Heathrow might come out as a smaller sort of project. There is a second Heathrow option that is half the cost. So what I would say is that large projects didn't cause Brexit, but general dissatisfaction did. And as infrastructure investors going forward into the future, I think that there's going to be as much a focus not only on the big economic side of things, but also on developing that type of community infrastructure, aggregating a number of smaller projects, particularly around cities and non-London municipal areas.
Julia, thank you for that. I just want to take you back to the early part of your comments when you talked about some of the big picture infrastructure projects. I mean, I work in London. I work very close to the apex of Crossrail and Thameslink. And it truly is a massive combination of developments. I walk around London and see thousands of workers having their lunch, having their smoke breaks. The fact that they're smoking tells you that many of these people come from Europe.
People do smoke in the UK still.
How are we going to be able to continue with these enormous infrastructure projects when key workers come from the European Union or maybe further afar? And we have this fundamental problem which stems from the Brexit vote on migration in general and free movement of labour. How are we going to square this circle?
Well, I think the British are well known for being practical and pragmatic. And one of the calls is for greater housing. I think there's a great statistic from the Barclay Group. They reckon that 50% of all of the workers building UK housing at the moment are from Eastern Europe. Now, the chances of there being such a curtain being pulled down on immigration that there are not going to be workers coming in from the rest of the European Union, I would have said is minuscule. Now, there are discussions. We don't know what Brexit is going to look like. Apart from the well-known phrase Brexit means Brexit, we really don't know any of the details. But when we look a little bit below the carpet, people are talking about work permits, they're talking about the potential for the continuing movement of labour. What I think is the real problem is the free movement of labour. And I think that pragmatism will come through in infrastructure. You know, there's an incredible shortage at the moment. There's a shortage of 250,000 workers needed in infrastructure. You know, no government, not even Nigel Farage, is going to say that there's going to be a stop on workers coming in. I would say the likelihood is there's going to be work permits and less potential for people to settle in the long term in the UK. But the working population is not going to be stopped moving across borders.
Excellent, thank you. I want to take one of the points that Julia raises and frame a question for Sven. Julia talked about the angry people, perhaps the disenfranchised people outside of London, the protest people, and the way that Julia described it, perhaps could have equally been applied to many of the people who are saying they're going to vote for Mr. Trump in the US presidential election. Is this a global phenomenon? This need for protest, and the actuality that people who have never voted before are starting to vote, and they're using that vote to make a protest statement. Is this a global phenomenon, or is this an isolated story?
Sure, it's a global phenomenon. I mean, so if we have the data, we have the situations in the US, we have it in many countries in the European Union. What I'm missing a little bit is the strong argument and the strong points being put forward by the liberal Europeans. They have been very complacent. They have been fairly quiet. I think now is the time for standing up and make the argument and say, yes, integration works well. Yes, the European Union is not always functioning as you would like it to function, but such is compromise. You never can get everything that you want. So I think the point is to be, for the liberals, for those who care about European integration, to be more forceful putting out that argument. We have been too complacent.
I mean, this brings me to what we were discussing last night over an excellent bottle of Azeri wine, Mrs. Merkel's situation. The German election. It's only 1 year away, and given recent results in regional elections, there is the very real possibility that the AfD may get representation in Parliament, and that could greatly change the arithmetic for the established parties in terms of coalition building. Can you talk a little bit about that? First, Mrs. Merkel, and whether she will stand, and what her prospects are of coming back as Chancellor, and if it's not her, who might it be? What should we be on the lookout for?
I believe that Ms. Merkel will stand, and I think that was also argued in the first panel. So there was a little bit of a debate about whether she still has the stamina, whether she's still wanting to do that. But I think there's a thought process in her mind that convinces her, yes, she should do that. The AfD, yes, I mean, so we had a tremendous transition of the German political party system. For decades, we lived with three parties, with the Christian Democrats, the Social Democrats, the SPD, and the Liberals. Then came along in the 1980s the Green Party, then came along the Left Party, and now we are blessed with a sixth party, the AfD. So we have a fragmentation of the German political party system, and now we have a situation where after each vote, people struggle to formulate and to find a consensus between the different parties that are represented in one of the parliaments of the Länder, or eventually in the Bundestag. So that will be more complicated. There's a big question about whether the Grand Coalition, SPD-CDU, under Merkel's leadership is going to prevail, given the AfD making it into the parliament, and new coalitions are going to be formed. So Merkel definitely is going to stand, but there is, I think, a not unlikely situation where others, such as the leader of the Social Democratic Party, might also look out for new majorities.
Thank you, Sven. I'd like to take this opportunity to throw the floor open for questions. I believe there are microphones out there. If people have questions, if they can identify themselves and tell us who they would like to address them to. I know that Katrina was talking to me about having a potential question. If you'd like to voice that one. Yes, it is. Yes.
I'm Karina Lochinkina from PwC. What we see with Brexit, it's what was kind of outside scenarios like Britain leaving a European Union, it's now a plausible scenario. What's on your experience, what your organizations are thinking about in terms of scenario planning and future planning, and how you review assumptions in the decisions that you are making at the moment?
Would you like to address that to anybody in particular, the whole panel?
I would like to hear the range of opinions if it's possible.
So I didn't catch who that was.
If anybody from the panel could comment on that.
Volunteers.
Could you just summarize the question? I couldn't quite hear it from here.
The sound isn't great, but I think the question basically amounted to what has changed in terms of your planning. How have you changed your planning?
I'll take the first stab at that. So Baker & McKenzie is an international law firm. Our London office happens to be the largest office of our 76 offices. And we are looking at whether we can continue as business as usual outside the EU. And there's some interesting little sort of quirks that have arisen. For example, if we want to advise on European competition law, we have to do so through lawyers who are admitted in a EU jurisdiction. So many of our competition lawyers are becoming registered lawyers in Ireland. Ireland being probably the only other common law jurisdiction in the EU. The thing that we are ruminating on, I wouldn't say we've come up with any conclusions, is whether we should be following what might be a trend amongst asset managers. I personally think it's unlikely to be such a trend, but there is some talk of asset managers, fund managers in London moving their operations to within the EU, and the most obvious locations currently for that would be, from a pure funds perspective, would be Dublin or Luxembourg. I personally think that's unlikely to happen in a major way. I think we're much more likely to see managers who haven't got another EU location setting up an office with substance in one of those jurisdictions, but effectively keeping the main operational team in London. But if we do see a significant change, we may find ourselves bolstering our teams on mainland Europe or indeed in Ireland.
Anybody else like to add? Julia.
Yes, Meridian is a fund that is based in, its head office is based in France. It already has a number of investments in the UK. In general terms, there is no intention to change the investment approach towards the UK. But in specific terms, and picking up the comments that I was making, we are continuing to enhance our investment into community-based projects, because we believe the dissatisfaction level does appear in other countries. I think the US has already been mentioned, and that there will be an enhanced need for infrastructure investment down at the community level in order to reduce the potential fractionalization process within countries. So it's a difference of focus, but no real change in investment outlook.
Perhaps time for one more question. I know there was a hand down at the front. If we can have the microphone. Right at the front table, please. It's coming. It's getting closer. There you go.
Thank you. Maurizio Tamagnini from Fondo Strategico Italiano in Italy. My question is for Sven Berendt, or whoever actually wants to add, and it's really on, are there any suggestions on how to rejuvenate the political project of a high-level Europe? From a concrete standpoint, I don't think the EU is going to break up, because it's actually much more coming up from the bottom than what we are marketing. Let me give you a couple of examples. If you go to one of the cities in Europe, you see how the kids, the youngest, are all from all over Europe already. There are 250,000 Italian students in Germany. German corporates have as a second market Italy, both in terms of production and in terms of markets in Europe. So this kind of Europe has already happened. The disappointment about, and I get to the question and repeating it, about the UK is not about the decision, which is very rational and very selfish, but is the fact that the UK have shown through the past and through their tradition the possibility to think high in terms of projects. Why are we not successful in marketing the United States of America as a long-term project in Europe? And are there any suggestions on how to do that more successfully?
I guess you have given the answer to your question yourself. I think we need a more bottom-up approach to Europe. We need more activity in the business community to move the European spirit forward. I think that's exactly the bottom-up approach that we need. European councils have become more like a ritual, so there's very mechanistic. So there's not a lot of stimulus coming out of there. Perhaps the Brexit vote, as we are talking about adaptive system, perhaps the Brexit vote will create a situation where we come together again on the leadership level and think about where we want to be in the next 15 years. I always say where we are today is a strategic decision a strategic decision that we have taken 15 years ago. Today we have to have a conversation about where we want to be in 15 years. And I think that is something that is certainly missing.
Do we have time for one more question? The answer to that is no. So I'd like to thank the panelists, Julia, James, Stefano, and Sven. Absolutely brilliant. Thank you very much. I enjoyed it very much. I hope you guys did too. Thank you.